So good evening, afternoon or morning, depending on where you are right now. It's my great pleasure to welcome you to this final webinar on climate change and inflation. So this webinar closes a series of 3 webinars that we had in the past weeks, in which we took a closer look at the links between climate change, the transition to a low carbon economy and inflation. For those who were present, if you remember, in the first 2 webinars, we first had Val Parker from the ECB, who was presenting his findings on the physical consequences of climate change, like flood, storms, drought, and their consequences on good prices and on inflation. And he told us that such events have an impact on inflation, but that this impact depends a lot on the type of event, on the context, and on other situation when they happen. So no clear conclusion on this side. On the second one, we had Rachel Mössler from the BIS presenting her research on the impact of a carbon price, which is a policy risk associated with the transition on inflation. So more on the link between transition and inflation. And she explained to us that the introduction of a carbon price, if designed appropriately, does not necessarily generate inflation, at least to worrying level. And we end up this series today with a panel in which we have the pleasure to have 3 central bankers or former central bankers looking at what climate change and the transition implies for inflation and monetary policy. So it's my great pleasure to welcome Misa Tanaka, who is the head of research at the Bank of England, and she joined the bank in 2002 and she held a number of positions across the bank, from monetary policy analysis, financial stability, and prudential policy areas. I'm also very pleased to welcome Kartik Athreya, who is a research director for the Richmond Fed, and in that capacity, he leads the policy advisory process at the Richmond Fed. And finally, let me also welcome Emanuel Mönch, who is a professor of financial and monetary economics at the Frankfurt School of Finance and Management. And prior joining the Frankfurt School, Emanuel was head of research at the Deutsche Bundesbank. And in that role, he co-led the work stream on climate change and monetary policy as part of.
Okay, so I think we expected this may happen with the connection that Pierre had, so I will quickly fill in for him for 1 second for the audience. And maybe what we can do is to start with our panelists, with Misa and then Emanuel, and then I can give some opening remarks. So Misa, the floor is yours.
Sure, thank you very much, Pierre, for inviting me to this very interesting panel. So the panel is about climate change and inflation. So I just wanted to quickly talk about how climate change and through what channels climate change might affect inflation. And my talk is largely based on my previous work with Sandra Button and Rhiannon Sarbatz. I should say also at the outset that the views I'll be expressing at this panel will not reflect the official views of the Bank of England or its policy committees. So I think climate change will manifest itself first and foremost as physical damage, and that will, in macroeconomic terms, that will manifest itself primarily as negative supply shocks. And those shocks we expect to become larger and more frequent as temperatures rise. So for example, extreme weather events could hit things like food production, but can also damage productive capacity of the economy. And such shocks will tend to generate relative price shocks and also push up on inflation in the short run. But such events can also generate negative demand shocks. So for example, extreme weather events could reduce household wealth, and also that tends to push down on consumption. And while reconstruction activities after natural disasters could increase investment, business investment could be also adversely affected by the financial losses suffered by firms. And we have previously said that this negative demand shock arising from extreme weather events tend to be larger the more uninsured the losses are. Also, the impact of transition to net zero will depend on how policies are implemented. So, for example, if policies to transition to low carbon economy is primarily implemented by a carbon tax, that in the near term tends to push up on inflation. By contrast, again, that would be a supply shock, but by contrast, if it's implemented via subsidies for green investment, that's much more likely to be a positive demand shock, again, pushing up on inflation in the near term. But of course, in the medium term, central banks should be able to keep inflation at target, provided that they respond to these shocks appropriately. But that said, I think there are a number of challenges that central banks will face here. And I think there are mainly three here. The first point to emphasize is that central banks' ability to keep inflation under control depends on their ability to manage inflation expectations. So one of the big questions here is if these shocks become larger and more frequent, central banks, the challenges facing central banks in maintaining inflation expectations anchored will become harder and harder as well. And I think this represents a challenge, particularly in countries where central banks have relatively weak credibility, and also in countries where things like food and energy constitute a large proportion of consumption basket. And the second point is to be able to respond to these shocks appropriately, central banks also need to understand the structural changes brought about by climate change and how they affect the long-term variables such as equilibrium in real interest rate and potential output. So for example, there is some evidence that gradual warming will reduce productivity and hence also the potential growth rate. But it's very difficult to discern exactly how quickly these things are moving. And the third point is to avoid undue macroeconomic volatility, we have to make sure that financial system as a whole doesn't play an amplifying role of these initial climate-related shocks. And here, that again underscores the importance of work that my colleagues in Prudential Regulation Authority and also financial stability areas of the bank are doing in ensuring that banks and insurers are resilient to climate-related risks. And in this context, I also wanted to advertise that we have a call for papers open for a conference on capital and climate. And we would very much welcome submissions on papers that consider the challenges with using prudential capital tools to ensure that firms are resilient to climate-related shocks. So just to conclude, I think it is very important that central banks understand and manage these risks and challenges arising from climate change. And in this context, it's also very important that governments outline a very clear set of policies to support the transition to low carbon economy, because that would also help reduce uncertainty facing central banks. Let me stop here. Thank you.
Thank you very much. And sorry for dropping off. I've been experiencing troubles with connection the whole day. Did I manage to properly introduce each of you, or did I stop to you, Misa?
No, you did introduce all of us.
Yes.
Thank you so much.
Okay, that's perfect. So thank you, Misa, for these first words. Emanuel, you want to also give a bit of insight?
Yes, first of all,
research on the topic and experience.
Thank you for very much for having me on this interesting panel with great colleagues that I'm happy to see again, and also some in the audience I've known for some time now. So I would like to make three points in my introductory remarks, and maybe we can touch upon each of them later in our discussion. The first point is that I think to study the effects of physical risks from climate change on inflation, we need to look at the distribution of weather events much more than just the conditional mean analysis that's typically done in the literature. And I'm saying this because I think that the tails are much more important than the distribution, meaning that large natural disasters have significantly larger effects on inflation and output than sort of smallish natural disasters. The second point I would like to make is that the transition to the net zero economy is not necessarily inflationary in the medium term. In fact, there is evidence now, even though we need much more research on this important question, that the medium-term effect of carbon taxes are actually disinflationary, which obviously poses them problems or potentially interesting issues for central banks. And the third point I would like to make is that research, of course, suggests that monetary policy should look through higher energy prices and stabilize core inflation based on DSGE models. However, much of this literature relies on basically the assumption of fully informed rational agents. And that assumption essentially may be a bit simplifying, since recent literature using survey data has shown that gasoline and food prices are actually very important for household inflation expectations. And so central banks may need to much more forcefully respond to higher energy prices in the transition than is basically implied by these theories that ignore these effects. And maybe I can now briefly expand on each of these points without spending too much time. Please stop me if I'm taking too long. We can always discuss some of these points later again. So on the first physical risk and inflation link, the literature has found a significant impact of climate-related weather events on inflation so far, particularly in emerging market economies. And here, especially droughts and heat waves lead to significant and relatively persistent increases of food and headline inflation. There's thus far relatively little evidence of a significant impact of climate-related weather events on headline inflation in developing economies. I think one exception to this is the recent paper by Miles Parker and co-authors from the ECB, who use cross-country panel data to show that extreme temperatures raise inflation in the short term, also in advanced economies, but lower it in the medium term. And importantly, in that paper, the authors find some evidence for non-linearities of this effect. So very hot summers have much stronger effects than not so hot summers. And that's quite intuitive to me. And it suggests that tail weather events have actually larger effects than smaller shocks. And it's in line with recent work I've been doing with Sulkan Shavleshvili from Aarhus University, formerly ECB, where we use a quantile vector order regressive model to study the effects of climate-related natural disasters on US economic aggregates. And here in the US economy, the largest and costliest disasters, natural disasters, have been major hurricanes, such as Katrina, Harvey, Irma, Sandy. And so when we study the response of aggregate US inflation and output to natural disasters, in a standard linear VAR for the US economy, we find essentially no effect. But using a quantile VAR approach, we find sizable effects of large disasters on inflation. So the tails of the disaster distribution have particularly strong effects. And that said, inflation responds also to large disasters in a relatively short-lived way. Now we use the model to do scenario analysis, similar to sort of the climate stress test scenarios that people are now starting to consider, with the view that climate change will increase the severity of disasters. And so, for example, we study a severe disaster scenario where we draw disasters going forward from the top decile of the historical disaster distribution, or an intermediate scenario where we draw disasters from the top quartile of historical disasters, and so on and so forth. And basically, we show that the price level rises sharply in both of these scenarios, with substantial upside risk. So we can study in this quantile VR setup the sort of distributional aspects of disasters, natural disasters on inflation, and we find that basically there's substantial upside risk in these future worlds, hypothetical worlds, where large disasters occur much more frequently than in the past. On the second point of transition risk and inflation, we know that the first best instrument to reduce emissions is to have successively prices or taxes on carbon. And of course, in our fossil-dependent economies, that will lead to sharply higher energy prices. And the conventional wisdom suggests that higher energy prices lead to higher overall inflation. But so far, there's been little empirical evidence on the effects of carbon prices on inflation. There's very few papers that study this. Conrad and Veda Di Mauro is a recent exception. They find higher overall inflation from carbon taxes, but a negative impact on inflation in services and non-tradables. Kensich from London Business School also finds a positive, a small impact of carbon taxes on headline inflation, but no significant impact on core inflation. Ultimately, I think we need to study these effects in general equilibrium models, and that's what I'm starting to do with Kai Lessmann and colleagues at the Potsdam Institute for Climate Impact Research, where we study the inflationary effects of the net zero transition implemented via a carbon tax in the DSGE model with a relatively rich energy sector and calibrated to the euro area economy. And our preliminary results suggest that a relatively steep carbon tax path has relatively small effects on headline inflation. And in our baseline calibration actually leads to lower core inflation in the medium term. And the reason is that in this model, there's relatively small substitution elasticities, which are calibrated to historical data between fossil and green energy sources. And so the rising carbon taxes lead to a substantial decline of overall economic productivity and hence a shrinking of the economy. And so this in turn puts downward pressure on prices of core goods in the medium term. And so I just want to challenge a little bit this sort of conventional wisdom that the transition will be inflationary. I think it depends a lot on various things. Of course, also on the monetary policy response. And this leads me to my final point on monetary policy and energy price inflation. There is a theoretical literature showing that the optimal monetary policy stabilizes core rather than headline inflation in response to oil supply shocks, for example. However, much of this literature assumes fully informed rational agents and of course, a fully credible central bank. And in any model of central bank, the optimal central bank response will depend on its effect on expected inflation, which in these models is essentially a bit simplistic. And there's a recent literature that shows that actual inflation expectations by households respond strongly to increases in gasoline and food prices, because those are prices that are more salient to consumers. We just shop for gasoline and food more often than we do for other goods. And so price changes in these particular sets of goods affect inflation expectations of households much more strongly than other price increases. And as a result, I think there is a risk that higher energy and food prices generate higher overall inflation expectations and hence require a much tougher response of central banks than in these benchmark models where this channel is absent. And that concludes my a few points. Thank you.
Thank you very much. Before giving the floor to Kartik, let me just remind you that you can ask a question in the chat. The floor will be open for question after these remarks, and I will relay your question to the panelists. But before jumping into question, Kartik, the floor is yours.
Great, yeah, thank you. It was a great bit of luck for me to follow my two colleagues here who said essentially everything that I might have said, but then in more, because unlike the two of them, I'm a consumer first of the literature and not a producer myself. But my colleagues here at the Richmond Fed are actively engaged in thinking about about papers in the paper production business, exactly in the ways that Emanuel just stressed. So rather than, let me just say a couple of things. One is that I really valued the way that they each and collectively framed the issues. I found essentially nothing myself to disagree with in terms of thinking about, how should we frame some of this? There's a supply side shock angle that Misa spoke about. There's the question of relative prices and should, to what extent do central bankers look through things? Should they look through things? There's the really brass tacks issue of physical damage being a very central component of all of this. Misa mentioned very briefly the idea of negative demand shocks in addition to supply side shocks. And I think this is something that I have also been influenced by. If you tie it together with something that Emanuel emphasized, which is that tails matter, this is something I think is going to be very important in a couple of ways. One is that I'm influenced, like many perhaps are, by papers such as the ones by Basu and Bandik, for instance, thinking about the impact of uncertainty and to what extent can it by itself create declines in activity. At a time when the effective lower bound seems, much more proximate than any of us would like it to be, I think we should be aware that we may be more often in situations where uncertainty combined with the ELB put central banking in a difficult place. This is, I think, an important point because one casual answer, I think casual but trivializing answer to the question is, well, in the short run, relative prices move around. It's picked up as inflation. Yeah, okay, that's going to happen, but it's really not a big deal because in the end, that the central bank is supposed to be thinking about longer run inflation, certainly, and often we don't have all the information that we need to manage things at a very high frequency. Often when it's relative price changes that are moving, there are sensible economic reasons when those prices, for example, are flexible to not necessarily react because you need the economy to be responding to underlying physical realities that we, all of us panelists, agree on as being critical for climate. But I think one of the things about climate that makes it a difficult thing for central banking is the uncertainty. And Emanuel mentioned tail behavior. This is something that I had planned to also talk about a little bit because the intersection of tail activity and macroprudential supervision, I think, is going to be an important thing. One of the difficulties that I have seen in my career, and now it's too late, but I should give you the disclaimer, these are my views and not those of the Richmond Fed or the Federal Reserve System. But one of the difficulties that I've perceived in operating in a central bank over my career is kind of getting to the salience to the broader world of the importance of kind of a muscular, robust procedure for macroprudential supervision that takes tail seriously into account. It is almost inevitable, in my experience, that as time recedes from a difficult event, let's say it was the great financial crisis or some other event, the arguments for viewing any given stance for regulation as burdensome and less as useful for preventing other kinds of difficulties down the road, there's a tipping of that balance that you see happening very inevitably. And I think one of the things that we need to keep in mind very clearly is if climate operates first and foremost in terms of tail events that are bigger than before, I think we may be challenged, unless those are so frequent as to constantly stay in front of people's minds. I think it's going to be a harder case for the central banking community to make to the broader world about, yes, this is the appropriate capital stance. Yes, this is the appropriate macroprudential stance. Yes, this is the appropriate way of looking at interconnectedness in order to think about systemic risk. So I really feel like some of the challenges on the regulatory side or the supervisory side will come in the form of communication and buy-in in a world where I think the natural drift will be, at least in inter-event periods, to drift away from it. And I think forgetting history will be easier the more onerous these regimes are, simply because they will look to many people as this is a lot of cost without some clear attended benefit. This is something that the Richmond Fed, of course, has been long concerned with in terms of thinking about how does the safety net more generally and the ability of the central bank and other parties to bail out in extremis influence risk-taking more generally. So not only is that salience going to be important to preserve in the minds of everybody involved, it's also the case that the failure to do so will probably lead to more risk-taking in a time and more shifting of risks away from away from private parties towards the public broadly defined, perhaps more proximately towards supervisors and regulators, and then on through to other authorities like the fiscal. So I think that's one aspect of TAILS that I really wanted to emphasize. The second aspect of TAILS that actually I'd planned to talk about was really thinking about how to convince the broader public about inflation expectations and expectations management. That I think will become a significant challenge in a world where you have large scale events where the prices that are, again, salient to individuals, like Emanuel mentioned, are moving in very adverse ways. Central bankers already have enough difficulty talking to the broader public when we say things like, well, the core measure is doing X. And then people will say, well, what do you mean? Do you not think I buy gasoline? Do you not think I buy food? This is a perennial challenge for central banks to communicate. Well, no, we look at these things, but it's important also to think about longer run price levels and what signals being conveyed, and when to look through what are very obviously relative price changes that may reverse themselves. This tightrope, if you want to call it, it's a little hyperbolic, but this kind of general tension in communication, I think, will be brought to the fore in terms of how people have to form expectations of whether the central bank is actually really controlling inflation the way it's supposed to be doing. This also ties, in my mind, to the idea of how to get the public to perceive what we do in terms of what is systematic versus what is less systematic. I fully agree with the comments made before that fully informed, rational individuals are not probably a great model at all times and places. I think that model of individuals will be uniquely stressed in the coming years because we're all navigating with the evolution of stochastic processes in our world that none of us, I think, understand that clearly. Our ability to understand exactly the level of uncertainty is not clear yet. Our ability to understand input-output linkages that my colleagues and others are working on is now getting a revival. But I think it's important for everybody to understand, especially those of you who are researchers will need no reminding, that this is putting us in some sense more in touch with the things that we don't fully understand about the real economy and the transmission mechanisms of a whole new class of risks. And I think as we navigate that risk at environs, is going to be much more important to kind of be communicative in ways that try to deal with the things that both Misa and especially Emanuel, you mentioned a great deal. So let me stop here for now, and then we can talk more in the Q&A. Thanks.
Thank you very much for this introductory word. I just remind the audience that you can ask questions. One general question for all of you. Maybe start with Emanuel on that. In terms of financial stability, we have results that show basically that business as usual scenario is the worst case scenario for financial stability, and a smooth and early transition that would be the one that is the best for financial stability and financial supervisors. Do you think we can have such a conclusion in terms of inflation? Is one scenario a smooth scenario, also the best scenario for central banks, in a sense? In which situation would central banks fulfill their mandate more easily, or which one is the most comfortable? And if you can't answer this question clearly, what are the dimensions that we should know or we should look at to understand whether the situation is going to be more difficult for central banks in terms of managing inflation, and which one is not? Can I start with you on that, Emanuel?
Sure, I can give it a try. It's a tough question. I think since inflation expectations are key for central banks to manage the business cycle, any transition that's disorderly and is likely going to have stronger effects on inflation expectations than an orderly, well communicated transition. So my hunch is that an orderly, well-communicated transition where firms and households understand well the path of carbon taxes or carbon prices that lies ahead of them is most plausible scenario for me that will make it relatively easy for the central bank, but still not easy for the central bank to deal with the transition. I think it will be challenging no matter how the transition works. I'm personally a bit skeptical that we will manage an orderly transition, given that how far we are behind the curve already. As has been clearly shown, the carbon budget available is only a couple of more years of doing business as usual. And so the later we start reducing carbon emissions, the more disorderly and rapid transition will have to be. And we're already very late in the process. And so I personally, I'm worried that basically we will not have an orderly transition, but a disorderly one. And with unforeseen consequences for inflation expectations. I think we haven't seen anything like this in the past, so it will be hard to judge on the basis of historical data how this will affect inflation expectations. And so it's clearly not easy times ahead, but I will now defer to my central bank colleagues to shed some further light.
Kartik, do you want to answer?
Yeah. Sure, I'll add one thing, and hopefully Misa can do better than I will. But I do think I actually agree very much with Emanuel in the sense that I have given, in fact, remarks to the broader public where I've argued that the sort of unmanaged outcome is actually the most likely one. I think everything is pointing to that outcome, or a very badly or slowly managed outcome on the actual physical abatement, dimension of climate management. I'm very skeptical that the requisite coordination will actually happen. I think I want to tie this back a little bit to kind of who loses from the inability to manage that transition. I think it is absolutely right that everybody loses to some extent, but I think I want to emphasize that the catastrophic losses, even just on the inflation side, to let's say nothing of the real side activity, are actually going to happen in emerging and low-income economies. That's where already some of the second moment disasters are happening. India has just, for example, gone through a heat wave of incredible proportions, which now, that we're all paying attention even more than before, is having implications for things like commodity prices. Both, wheat prices, for example, are going to change. Food prices and more general stability is something that the literature has broadly looked at and found to be quite connected. So I think if you want to look at disorder, my guess is that right now, the unmanaged outcome is the likely one. B, it will result in extreme events in emerging economies that are least likely to be able to bear them. And C, those are probably going to be more often tied with challenges to governance in those places more generally. And that sounds, again, somewhat extreme, but I think, if you look at episodes in the past where really sharp changes in food prices have happened, they are very difficult to manage. And a central bank that is asked to manage and think about inflation will have its hands more than full in trying to deal with those things. So I think it's really important to think about the likely path in which we'll have to manage from a central banking point of view. It's possible that the relatively well-off countries of the world can afford for a bit longer to have this transition not actually be put into place in a meaningful way and still kind of go along with normal central banking business as usual, I think you called it, Pierre, practice. I think that will be severely challenged in the even shorter run in a bunch of other places in the world, and where the welfare economics, I think, are extremely serious. So let me stop there, Misa.
I think the other panelists have already said the right points. I mean, I don't disagree with anything that Emanuel and Kartik said now. I mean, the only thing I would add is what does that mean for central banks? So I think the big unanswered question here really is, if the world is going to be much more volatile going forward, there's going to be much bigger supply shocks, there's going to be much bigger relative price shocks, and that's going to occur more and more frequently. then do we have the right framework in place to respond to that? I think that's the big unanswered question here. I think more and more central banks are starting to think about this issue, but fundamentally the question is, do we have a framework to respond robustly? Do we understand how this will feed into inflation expectations? If things don't go according to plan, if there's a second round effect, how do we respond? All that could be to some extent answered within the existing way of thinking, but we don't know that yet. I think to some extent it will depend on the frequency and the size of the shock. If large shocks occur year after year after year, we might be in a different world from where we started, where we were, let's say 20 years ago.
Oh, sorry, Pierre, go ahead.
No, go ahead, Kartik.
I think I just want to underscore something Misa said. I mean, it ties back to what Emanuel said earlier. In the United States, even in the last year or so, there has been a robust discussion on expectations formation. Obviously, the academic literature has been thinking about this for a long time as well. And that discussion came up, not because of climate necessarily, but simply because the US was, drawing values for headline inflation that looked very outsized, and they were connected more to things having to do with COVID, for instance. So, it's just an example of how what is happening in the real world is going to make the challenge for communicating and understanding expectations formation, which again, I think I wouldn't say glossed over in the models, but it's handled in one way in our models typically, simply because, it's not trivial to think about how else it would be handled than the way we do it. But that of all the assumptions will be tested, I think, much more, forcefully in the scenario that Misa pointed out. More big shocks, more frequent shocks, central bank communication, you can imagine facing challenges about saying when to look through, what not to look through. I just imagine them being much more significant, and navigating political economy inevitably while doing so. I think all these things feed together.
I mean, Kati, you just focus on expectation formation, and that's something that appears in all three of your comments, the importance of having anchored expectations. And you just alluded to at the end of what you just said, but what do you think would be the greatest challenge for anchoring expectation coming from climate change? Because, Misa, you highlighted that if large shocks comes more and more frequently, then it might going to be difficult to kind of convince people that they have to look through. And how can central banks then enforce or anchor this expectation in that context? Using the same tool, Misa, you also spoke about, do we have the right framework for that? Any remarks or thoughts about what could happen in terms of inflation expectation, and how what central bank will see as a challenge in the future for that? If anyone wants to have a first try at it. And in the meantime, I just reminding people that they can ask questions in the chat. So Emanuel, Misa, or Kartik, do you want to?
Yeah, I mean, I can say a few. I mean, I think the key concern is what happens if shocks after shocks keep inflation high. I think that's the scenario where we need to be concerned about. And this whole idea of look through a shock, let it pass through, hinges on inflation expectations staying anchored. And I think, as Kartik already articulated, I think communication becomes key, and communication is going to be the key challenge to explain what central banks are trying to do when very large shocks keep on hitting the economy. And I think that would be, one thing that we need to still think about. Maybe other panelists have views.
So one thing that this is going to be in the spirit of live panel discussion. So I hope that it makes sense. For me, when I think back to the cardinal event in kind of recent US monetary policy history, it was the resetting of expectations in the early 80s, away from high and variable to something, low and not at all variable. That in some sense offers some glimmers of hope, in the sense that I think a reasonable consensus was that while the recession that happened, en route to re-administering expectations was severe, it was not as severe as I think a very naive look at a world in which communications were not important, in which credibility was not important, would have suggested. So I think we have an experience, at least in one case, where we've been able to re-anchor expectations through forceful action. And now the thing is, of course, this is not the situation you want to find yourself in on a regular basis, because that was a very costly re-anchoring, even if it wasn't as costly as maybe the worst case scenario expected. I do want to double down on what Misa said, though. The scenario in which I think it becomes very difficult is a series, maybe even a priori unlikely, of bad events, each of which leads the central bank to potentially want to look through, but each of which ends up showing up in inflation prints that may lead others to say, well, you are not so committed after all. And I think it's going to be difficult to avoid at least some realizations in some periods in which that's exactly what's happening. And then I don't want to, I think, understate the pressure on central bank independence that you may see in those instances as well. This is not something that I think any central banker can wish away, where there may be times in which the unpopular decision to re-anchor expectations, if you take my 1980s as an example, that requires broader consensus to achieve. It is not something I think that a central bank all by itself can simply say, this is what we're going to do, and this is how it's going to create stability in the future. I think broader parts of society have to coalesce around that being the need of the hour. So it's possible that if you have the series of unfortunate events, that the way that Misa mentioned, you will have central bankers under more pressure with less consensus, because the distributional consequences of the shocks, the real shocks, will actually be of a kind that I think is not easy to kind of look past for any central bank, especially one with an employment mandate in it, and then react to. So I think these are real politic kind of considerations that may actually make the job hard in the future.
Emanuel, just before you take the floor, I mean, there are also questions about the deflationary aspect that you mentioned in your introduction. So that might also constitute another challenge for anchoring expectation, or a different way for central bank to answer. Maybe if you can add on that aspect, or if you don't think it's really matter.
Oh, no, I was actually going to say that communication will be key. I think what central banks have to avoid, and that's irrespective of climate change and its impact on inflation, is a situation where long-term inflation expectations are highly sensitive to news about the near-term inflation outlook. So basically, you want long-term inflation expectations to be very stable and not react to near-term events. And that's a situation we've been seeing in developed economies since the late 90s, pretty much, because of this very costly disinflation that was done after the energy price hikes in the late 70s. And so with the Volcker disinflation and basically similar policies in other countries, central banks have managed to achieve a situation where long-term inflation expectations were very insensitive to short-term news, and that's exactly what you want. This is basically how I would define a proper anchoring of inflation expectations. It's long-term inflation expectations are insensitive to short-term news. And this, of course, can also be achieved not only through action, but through communication. And I think explaining clearly the trade-offs of the various inflationary and disinflationary aspects of climate change is something that is challenging, but can be done potentially. And so in addition to responding sharply when, as a central bank, in terms of hiking rates when inflation expectations go up more than you would like, you can explain basically also the disinflationary pressures that the transition might imply, and that in principle could potentially have an impact also on inflation expectations in the long term. Now, you would have to do this with very clear sort of language and targeting basically different types of audiences with different types of or backgrounds and financial literacy levels. And so I think clearly central banks, and the Bank of England is a prime example of a central bank already working with communication sort of tools aimed at sort of various groups of households with very simple messages is key, and that's one instrument that can be used in addition to rates policies.
So Pierre, let me just, if I may add one thing to what Emanuel said, like as listening to him, you know, speaking very bluntly, for me, sometimes there's an opportunity also for the central bank in that communication to coordinate better with other authorities that are much better positioned to soften the real implications of some of the actual climate events. And I think it's very critical, at least I'll speak very personally here, for the central bank not to be seen as the frontline tool for a lot of different kinds of real side economic events. There are clear limits to what it is that I think a reasonable person can expect from central banking. And I think the further one gets from those things, the more difficult a task that the central bank sets itself up for, and the more difficult that expectations and credibility management really is. And Steve Cicchetti, I think you put in the comments in the chat the question about, you know, risks to credibility. Well, to some extent, I think, you know, while I don't want to go so far as to say will threaten the credibility, I think it will intensify greatly the challenge of spelling out those things for which the first order implications are best handled by fiscal authorities, and those things for which the first order implications are best handled by the central bank. So that's another dimension of the conversation that I think will have to be intensified going forward.
Let me now just turn to two issues that have not been raised so far. So one is about the distributive effect of inflation, and also the cross-border effect. So you can react to both of them, but one thought about inflation is and distributive effect is obviously that some of the inflation that we see now are, you know, putting a higher burden on poor households, and the restrictive monetary policy that could fight this inflation rise tend also to show up in unemployment, which penalize the same people. So are there ways to get out of this conundrum? And on the cross-border side, a lot of, for example, physical or food inflation go through inflation, through exchange rates and trade. Does that bring specific challenges for the central bank? I'll let you take the floor if you want to react to one or the other of this topic. Emanuel, yes.
Maybe I can start here on the cross-border effects. I'm not an expert. I would rather pass on this one, but let me briefly say a few words about the distributional effects of inflation. So inflation, of course, is a regressive tax, and so as you mentioned, Pierre, it really very much affects the weakest households the most. And so that's also the reason, or one of the reasons, I'm so worried about the speed of the transition. And Kartik mentioned earlier the political economy of the transition, which is key. And we've seen it recently in Germany. Energy prices had been going up, not least because of the terrible war in Ukraine. And the first response of a newly elected government who has another 3.5 years before they are up to re-election was to actually temporarily lower the taxes on gasoline and diesel. And so you very much have this sort of typical reaction of policymakers to sort of ease the burden on and basically then the signals of higher prices and the necessary adjustment of consumption is lost. Instead, better policies would be to raise carbon taxes and then redistribute the proceeds in a lump sum way or whatever. There's different I think approaches out there that can be considered, but I think really you need the signal from higher energy prices and lowering taxes on gasoline, for example, as was done in Germany, is clearly a wrong policy, but it just shows that it's going to be very difficult for governments to actually manage the transition, and so I think that's part of the reason I'm so worried about the speed of the transition being too slow.
Maybe I can add one quick comment to that. I think what Emanuel says is something that I feel that every economist, wishes for the public to kind of have more acceptance of, which is this idea that not every price is wrong, but then there are serious distributional considerations that society needs to deal with, and so deal directly with those. Almost inevitably, the response is to actually target specific prices to achieve a particular kind of redistribution. This is everywhere all the time. It seems like that's a pretty decent description of how policy reacts. Against that backdrop, it's difficult, again, to see highly efficient responses actually taking place. Now, the problem with inefficient responses would be perhaps less first order if they landed on the best position to deal with them. But as Emanuel pointed out, I think that's extremely wishful. It's the consequences of inefficient arrangements, ones that ignore price signals. They also hit relatively weaker parts of society down the road in significant ways. So I think this is just a basic consequence of people broadly not accepting the way that I think economists generally reason about the role of prices in society. I think you're kind of seeing what happens when that is not widely accepted as a result, as a way of thinking. And I don't know that I can solve that. In fact, I know that I cannot. But that is, I think, something to be recognized as a significant, constraint on all of us. I mean, on a more positive note, across two administrations in the United States, so I'm emphatically not making a political statement as a central banker, we saw in the COVID response a really significant incomes type of support response in the United States, one that I think probably obviated the need to do other more complicated kinds of things. These were complicated by themselves, but then in some sense, there was a very concerted effort to say, no, this is something that the fiscal side of the United States needs to help households navigate. It was done in unprecedented scale and size and speed, again, across a couple of administrations. And I think, I don't want to speak for policymakers in the Fed, but there's no question that that level of support allowed the central bank, all else equal, to stick to its mission more tightly than it could otherwise have done. That part seems pretty clear to me.
Misa, do you want to rebound on that, or otherwise I have one maybe final question from all of you that was also in the chat. So basically, if inflation would raise because of climate or transition event, one possible natural answer for central bank is to raise interest rate, and that could bring a challenge to the transition itself, because you need cheap investments. How likely do you see that happening? Do you think it's a real challenge, or it is not? Or are there ways to circumvent that? That's also one of the questions, by adopting other type of reaction. Maybe if you can have a quick reaction on that before we we close the panel in 5 minutes. Anyone want to start?
Happy to start. I think there is a risk that by having to raise rates sharply in response to persistent upward pressures on inflation, the transition is being slowed down because of higher funding costs. That said, I think it's also a bit of a misconception to think of only central bank policy driving interest rates in the economy. I mean, we know that the central bank manages interest rates sort of over the business cycle, but sort of the structural drivers of interest rates are something that I think are also key. And here, of course, the great need for investment in the transition is actually putting upward pressures also on the neutral level of real rates, which the central bank is essentially setting rates around. And so I think it's not just the central bank policies that may impinge or have a negative impact on the speed of the transition. It's also the urgency to invest so much in a short period of time to get the transition done, that pushes a lot of upward pressure on real rates, and that is in itself is essentially making the transition harder. I think that's more of a problem than central banks having to react to higher inflation rates. At least that would be my quick response to this question.
Just to pile on to that last point, I mean, I think if you think about the physical risks, in many ways threatening productivity growth more generally, or slowing longer run growth down, I mean, that only makes things like the effective lower bound, I think, a little bit more, salient in the coming years. So that again will, I think, be an issue for central banking, just coming out of the depressive effects on our star measures, potentially from a more volatile and perhaps slower growing world economy.
Thanks for that. I mean, just as a food for thought, one of my colleagues at the Council Economic Policy is suggesting to have differential in interest rates depending on loans for green or for brown investments. So in a sense, you could kind of tighten on the brown side and still keep space on the green side. I don't know if that's a solution that is worth further looked at, but I'm happy to send you that if you're interested. That being said, thank you so much for coming to this webinar and accepting to present in this panel, Kartik, Emanuel, and Misa. It's always very interesting to hear different views on the same topic. Before we close, and I will give you a last word after if you want, but before we close, let me just announce the next webinar. We'll start a new series of 3 webinars on one issue, and this time we will look at uncertainty in modeling climate economics. And the next seminar will be on May 23rd with Michael Barnett, assistant professor at Arizona State University. That being said, thank you very much to all of you. If you want to have a last word, that's the right time to do it.
Thank you for having me.
Thank you very much.
Likewise. Thanks for the great questions also.
Thank you. Have a good evening and see you in 2 weeks. Bye-bye.
Thanks.
See you soon. Bye.